Hi everybody, it's me, Gregory Mannarino. How are you today? It is Monday, September 14th, 2015. All right, people, let me start off with this. Despite the propaganda that you are probably hearing from the mainstream financial channels, I can tell you this with absolute certainty. This market continues a very disturbing technical breakdown, which is getting worse. What does that mean for all of us who understand reality? I've been talking a lot lately about how this market is poised for a great fall. In fact, I've said a mega stock market crash is upon us here. Everything is progressing in exactly the way you would expect it from a technical standpoint for that to be occurring within an extremely short period of time. Several weeks ago, about 3 weeks ago maybe, I had said a major stock market event was weeks away. Well, we're closer to it now than I think we have ever been. And what you're hearing, without exception, from the mainstream financial channels is frankly comical. They're still pushing the narrative that people should be buying these dips. But what they will not tell you is this: traders are betting against this market at almost 2 to 1. If you follow any of my work on Facebook or Twitter or LinkedIn or Google Plus, I posted an options statistic sheet from today which shows you clear as day how traders continue to bet against this market at nearly 2 to 1. Meanwhile, the mainstream is telling you to buy the dips. There's a reason for this, people. It's very simple. Understand, it's part of the propaganda mechanism. They need to keep the market liquid as much as humanly possible. And why? Again, we are in the midst of a wealth transfer. The Federal Reserve has created an environment of risk. The only place you can be and people are rushing into is the U.S. stock market. And despite this market falling about 2,000 points since I nailed the top almost to the day back in May here, the market is performing very well despite other things that are occurring. Let's talk about a few of those other things here. If you follow my work, you've heard me talk about divergences. Divergences are very simple to understand. For example, if an asset is moving in one particular direction and indicators or other assets are moving in another way, you have a divergence. So what we're seeing here is a global divergence with multiple legs to it. Number one, unless you live under a rock or believe the nonsense garbage propaganda out of the mainstream, we are in a global slowdown. It is absolutely clear, despite actions by world central banks unprecedented in history to keep it all propped up. So, with that said, again, we're seeing this global slowdown, a meltdown with regard to the second largest economy in the world, China. They're doing everything they can to try to keep it propped up, efforts that will not work over the long run period. It's incredible. We're seeing a meltdown in commodities as well, but the U.S. stock market again has held up pretty well on diminishing volume, still down 2,000 points since the top, but still holding up. It's going to be the last peg to fall here, and it's being set up perfectly. Again, we are in a technical breakdown which continues to get worse. These are the facts, and you won't hear any of this out of the mouths of the mainstream financial professionals who again, have an agenda. Every word that comes out of their mouth, there's an agenda behind it, period. We also heard this today. Nobel Prize winning economist Robert Shiller once again is trying to warn the markets as to what is occurring. He said, well, he's a little late to the game again, but he's saying that the U.S. stock market is bubbly. Are you surprised to hear that? Look, are we all smarter than these people? I think what's going on is when you have big lofty people like that coming out, starting to voice what they see coming at this particular time, they're trying to preserve their own credibility. Talking about credibility, let's talk about the Federal Reserve. We're supposed to hear something out of the Federal Reserve today, whether or not they're going to raise rates or not. Wall Street pretty much believes this is a toss-up at this time. Look, The Federal Reserve's credibility is without a doubt on the line here, and they may be forced to nudge rates higher. They really can't do it in this environment. I mean, think about it. For 9 years, they have not raised rates. And all of a sudden, they're going to raise rates in this environment where we have a labor force participation rate at near historic lows, money velocity near historic lows. Look, there's no real recovery here. It's all been propped up by a runaway central bank, the Federal Reserve, and this is going on globally. All they've created is a debt bubble, the greatest threat to humankind, period, the end. Speaking of debt, we're finding out more and more China is dumping U.S. debt. Other countries around the world dumping U.S. debt. Why? Because their economies are in free fall. They need to raise cash. This is going to cause a ripple effect throughout the debt market, currency market, and we can expect all those bills, something I've been saying for years now, as these assets, debt as an asset, well, we'll talk about that in a second, being dumped. Where do you think all these extra bills are going to go? They're going to come right back here to the United States. We're going to see inflation at one particular time. No doubt about it. And it could be extreme. So debt as an asset. Let's talk about that for 1 second here. Debt is only an asset if it can be paid back. It can never be paid back. That's all we've been hearing for years. It's absolutely clear as day. So if the debt is not an asset, it's a liability. You understand? So this is the situation that we are in, and all of these divergences are going to play out in the U.S. stock market, again, in a massive technical breakdown. If this progresses, we could be, again, on the threshold of a major financial event, which is going to wipe out the wealth of a great deal of the population. Let me go back to the Federal Reserve real quick here. Again, I've been saying for the longest time they can't raise rates. They most likely won't raise rates, but I'm a little leery at this particular time. Why? Because the Fed's credibility is clearly on the line. And whether they raise rates now, which they know they can't do anyway, or they do it in December, whenever, it's always going to have the same cause and effect, and the effect is going to be bad. And I even believe if they don't do anything, the effect is going to be bad. Why? Technical breakdowns are occurring in major divergences. You understand? It's incredible, people. It really, really is. All right, look, before I keep running off at the mouth here, I hope I've covered some things that are really important. Let me just say this. I wrote an article about how most people are unable to see what to me is clear as day, and I'm sure it is to you as well. It goes over, again, how most fail to see a stock market crash occurring right before their eyes. Ben Bernanke couldn't see it. Remember in 2008 when he was asked, no, blah, 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 blah. He didn't see anything to do with the housing market. Meanwhile, it was melting down around him. So take a minute, check out that article. I'll place a link in the description of this video and in the comment section. Also, later on today at 5 p.m., I'm going to be live on alltalkradio.net. Call in. It'd be cool to talk to some of you out here, and we'll see how that plays out. With that said, people, I will let you all go, and I'll see you all soon. Over now.